Hi, I'm Kat, and today we are going to discuss the home buying guide. And the reason I feel compelled to create this home buying guide is because there's so much advice out there that does not account for much more basic education as well as what the impacts on the federal student loan debt, i.e., what are the impacts on debt to income? Do student loans have? And how can student loan borrowers, especially with more debt, use the rules to their advantage so that they can qualify for a home? So this segment is a home buyer guide specifically for student loan borrowers. So let's talk a little bit about step one. How do lenders determine how much a person can borrow? There is a lot of regulation in the market. So for example, if you earn, let's say, $5,000 a month, the government protects people from defaulting on their mortgage or from over leveraging themselves. That's a technical term, but that basically means protects a borrower from having too many debt payments relative to how much they earn. The government protects people by having a ratio. It's called the debt to income ratio, but there's a back end ratio. And there's a ratio in the mortgage process that determines how much you can borrow. And this determination is such that you don't end up with more debt payments than income. And as a result, put yourself in a really bad financial situation, right? So this ratio, depending on the loan, is about 43 to 46%. It also depends on the type, the lender and their risk appetite, right? But it's 43 to 46%. So that means that the amount of home plus all your debts cannot be, I'm going to just use 46% in this example, cannot be over 46% of your monthly income. Okay. So that's how the lender determines how much you can borrow. It's basically all your debt payments, a percentage of your income. So let's do a really quick and dirty example. Let's say, like I was using $5,000, right? If it's 46%, then 46% of $5,000 is going to be under $2,500 for sure, because that's 50%. But let me just get exact numbers. Will be $5,000 a month times 46% is $2,300. So in this scenario, a person cannot have over $2,300 in debt payments. So this is how the debt to income is calculated. Let's say it's all your debts divided by your monthly income. So let's say you have a $100 minimum credit card payment. So this isn't like to pay off your balance, but minimum credit card payment plus, let's say right now your student loan payment, you're about to enter a payment, is $500. Okay. That's your student loan. So how I'm doing it is all debts like this. In this example, it's credit card plus student loans, credit card plus student loans, plus whatever other loans, automobile loans, personal loans, any loans. It includes all of them. But in this scenario, we're just going to say you have a credit card, a student loan, just to keep the example simple, right? And then it's going to be divided by the income, because it's all debt divided by income, because that's what creates a ratio. And again, the monthly income I'm using is $5,000. So this will create what's called the front ending ratio, which is the ratio before the mortgage is added. Okay. So this will literally be $600 divided by $5,000, right? That is about 12%. Right here sits at 12%. So the remaining 34% can be used on a mortgage. So we know 600, we can also take 2,300 minus the 600 from other debts. That essentially says that a person can afford a mortgage of $1,700 because I'm taking 2,300 minus the 600. That's $1,700, right? That's how much they can afford in a mortgage payment. which for a lot of people that sounds pretty good. But I'm going to show you how the student loan that we used, a $500 example, how the different mortgage products treat the student loan differently. Okay. And it's especially important because we're about to enter into time of repayment, which if you have a payment of $500, you can use that. But I'm also going to show you how to manipulate it. Okay. So let's say, for example, you have other forms of debt that add up to be quite a lot. Okay. So really, really quickly, $1,700 of repayment of your mortgage will make it so that you get the maximum debt to income, which that's called the back end ratio. Okay. So the idea is to prepare for the mortgage lending process. If you have what's called high debt, and they say we can't lend to you because you have too much debt, there are things you can do to manipulate it. You can pay off your credit card. If you have an auto loan, not in this example, you could pay off your auto loan or sell your car so you don't have that loan. Or you could pay off your student loan. Let's say this student loan is $50,000. You're not going to be paying off $50,000 anytime soon, right? So there are ways to manipulate the student loan payment legally, so it's not illegal. Let me be clear about that. That will allow you to afford more home. And how you could do this is you can go on to different federal student loan plans. The one we like to recommend to borrowers is consider going into an income-driven plan. And the income-driven plan includes SAVE, Pay As You Earn, IBR, ICR. And the reason why they're compelling is because if a borrower is between jobs and they have no income, they can file and get a $0 payment. And that $0 payment will essentially, they can qualify for the only mortgage product you can qualify for with a legitimate $0 payment is a Fannie Mae loan. A Fannie Mae will actually accept a $0 payment. So in the instance, if you had this student loan payment, which is calculated $500, now let's say we took the impact of the student loan out entirely and it's now only $100 divided by 5,000, right? Because the student loan is zeroed out. Your monthly mortgage payment, well, first of all, 100 divided by 5,000 is only 2%. So you literally have over 40% of your debt to income can now be used for a house. But essentially that will allow you, on top of $1,700, you can literally add the 500 more, which means your mortgage payment now according to these rules that will allot is a $2,200 mortgage payment, which will allow much more affordability than a $1,700. And with these interest rates, right now it's 7%, the amount of your monthly payment doesn't go as far as when interest rates were 2 or 3%, right? Because higher interest rates make it so that each monthly payment stretches out to be not as much. I have a video where I posted on our calculator that goes over our calculator to help determine eligibility. And I know I talk a little bit about Fannie, but the guidelines around debt to income is that if you're not in repayment, all Freddie, Fannie, and FHA treat the student loan differently based on your balance instead of your payment. So in this context, we use the payment, right? Because your student loan payment is $500, so the lender uses that. When it's in forbearance or deferment, they would use a percentage of your principal, which is the total amount owed on your student loan. So I'm going to take this out. So we talked a little bit about debt to income. I'm going to erase this for now. And I'm just going to talk about the guidelines. Fannie uses 1% of the principal, right? Freddie uses 0.5% of the principal, 0.5%, and FHA also used 0.5%. So now let's say you owed $100,000 in student loans. If you owed $100,000 in student loans, Fannie would count it at $1,000 and Freddie and FHA would count it as $500, okay? The reason this is so compelling is because that example I use where you earn $5,000 a month, if you're in forbearance, deferment, or you're in school, let's say you're going back to school and you want to understand how much house while you're in school, you're working full time, but you're going to school and you want to determine the impact of your student loans and you're not in repayment, for example, they're going to use a percentage of the principal. So you can see from the example I just used, using the $500, we can see the impact was loud and clear. You'd add all the debts. Now imagine instead of, let's say, the credit card payment plus 500, that's the FHA and Freddie impact. Now let's say divided by 5,000 to use the same income to make it more understandable. And let's say Fannie uses 1,100 plus 1,000 divided by 5,000. This has a huge impact on the debt to income, right? Because now this was 1,700 as we determined it. And this is 1,100 divided by 5,000 is literally 22%, okay? So that's taking up a good percentage. We do know $5,000 times 46% only is 2,300. So if you're going to do 2,300 minus 1,100, you're literally now taking your mortgage payment to $1,200, which is significantly less home than 1,700, right? By an order of magnitude, like $60,000 less. And we can go over the calculator in a different video, but the idea is to show you the impact on the debt to income formula, okay? And understanding it. So it's really important that not only do we not allow or want the lender to use a percentage of your balance, because oftentimes they don't know the rules and they'll automatically default towards using a percentage because they're not as detailed with the student loans. That will really negatively impact your ability to buy if you have any sizable amount of student loan debt. So what we need to ask the lenders to do is to use your payment instead of your percentage of your principal balance, because for a lot of people, this $100,000 of student loan debt, they can reduce their payment pretty significantly based on their income, as long as in the context of this person, $5,000 a month is a $60,000 earning. And with Biden's new program, if you have a family size of 4, your payment is $0 up to $67,000. So literally zeroing out the impact of that student loan. And Fannie, if you're in repayment, right? This is if you're not in repayment, lenders will still use this. But if you're in repayment, lenders will use your payment. If it's 0, Freddie and FHA do not allow 0. Fannie does, though. So if you're earning in the context of this person $60,000 under Biden's new program, if you have a family size of 4, your payment's essentially 0. If you are single, your payment's still going to be under $200, which is a better treatment than even 0.5%. Okay. And it's also definitely a better treatment. $200 is better than $1,000, right? So the goal is to reduce the student loan payment, and the best is to reduce the student loan payment in the DTI ratio. That's really the goal. And it's a hugely important goal for so many people with student loan debt, because without reducing this ratio, then a lot of people get disqualified and can't buy a home, okay? So if you are an individual impacted and you're interested in learning more for your specific scenario, like with your earning, with your income, with your student loan balance, with whatever various form of debt, you should definitely visit us at app.myloansense.com. And app.myloansense.com, you can create an account, get a free analysis with your student loan plan. And what we tell you is what we can get you into a program. And Freddie, Fannie, FHA can use that payment. FHA and Freddie, as long as it's not zero, you can use that. And of course, we can provide personalized guidance. I hope this has been helpful to understanding a little about how debt to income is calculated and how the guidelines treat student loans. Again, we're here on standby to help. And we can't wait to get you started because we'll also help you get the right documentation to close with this lower student loan payment. Keep in mind that a lot of lenders overlook the details of the debt to income and will only use a percentage of the principal, and that can be harmful. So let us know if we can be of assistance. Please like, please subscribe, please share if you have other student loan borrowers who are interested in buying. And we can't wait to help.